Okay, folks, welcome, welcome, welcome. We're going to be talking about a couple things that probably going to challenge your preconceived notions about some classical analysis concepts that's typically bandied about as the science of technical analysis. And it's my motivation to inspire you to go into your charts and see if what I'm teaching you here today is what exactly happens just about every single trading day. Just as a reminder, my background is in computer science and information systems, so I am a byproduct of the computer programming generation. Right now, at the time of this recording, I'm 45 years old, so I've been around a long time, and I watched the transition from the open outcry pit trading to electronic trading. So while many have in the past struggled to move and transition from floor trading to off floor trading, I think I've had the advantage of thinking about things from a higher level analytical standpoint. And by that I mean I'm already accustomed to algorithmic thinking. So while it's not important to teach the concept of computer programming to understand what I'm going to show you here, just understand that those that have these um, experiences, if you've done any work in computer programming, what I'm going to suggest to you is going to make perfect sense to you. Everyone else, probably not so much, but you'll be able to see it by experience and seeing it in the charts. Okay. First and foremost, price is not random, and price is not a byproduct of supply and demand either. Most folks that come into this business will buy into all of the misinformation that comes by way of instruction, books, seminars, teaching, this, that, and other thing. And the first and foremost thing that comes out of their mind is, you never really know. And while I'm not preaching 100% accuracy, I am preaching a diametrically opposed position to what is deemed as classical technical analysis. My belief is it's not about trend lines, it's not about indicators, it's not about support and resistance either. So before I go any further into it, just understand that everything I'm teaching you here is my personal belief. I started like everyone else. I started with the ideas that are taught and promoted in books and educators, and I did the same things that anyone else would do. The problem was I wasn't profitable with any of it, and I tried very, very hard. And it wasn't until I looked at things with the perspective that if I were trying to upset the individuals that are trying to do the things that the books say, how would I go about doing that? What I was creating was a documentation stage of a computer program, okay, from a systems analyst perspective, okay. I looked at the market as a whole, and if I were to be able to wrangle, okay, everybody's collective thought process, or at least the majority, to think about a specific direction or a specific level of interest in price, how would I go about doing that? And how could I do it on a repeating fashion? Because my belief is price is not random, and if you've watched anything of my work or examples in my trades, you'll see that that's pretty much a no-brainer. It's very predictable, and if we understand that there are individuals or entities or now an algorithm that controls the fluctuations in price, how do we argue and wrestle with the idea that what was going on before electronic trading? Well, it's the same theory that it's used, it's just been automated. The folks down on the floor, when it was open outcry only, the illusion was they were helping push price up or pushing price down. And the fact is that's not true. And the reason why I knew this was most likely accurate is because I learned my S&P trading from George Angel. And George Angel was a floor trader for the S&P. And he said specifically in many of his teachings that he left demoralized certain days. He lost a lot of money on some particular days where if he had the insight that everyone would assume they have on a floor, he shouldn't have been having these big suffering losses. So what was going on those days? Manipulation. So my belief is there's always someone pulling the strings. Now, I can't introduce you to them. I can't say here's where they reside, here's where they originate from. Okay, so there's going to be a certain measure of Tom Clancy in this. Okay, by way of I guess you can put the quote symbols around it, quotation marks, if you will. Conspiracy. And if that upsets you and bothers you, just turn the video off. I really don't care to try to convince you of it. Okay, but if morbid curiosity has kept you on this long, I promise you, you will be rewarded. So the mechanics of price manipulation started in the beginning. Okay, it's always been there. As long as there's been a market, there's always been someone in control. Otherwise, it could crash. Any market could be completely decimated if it was sheer by way of the buying and selling that takes place on speculating. That's it. And they build in these ideas, these supposed circuit breakers. Oh, we're going to stop the selling from causing the market to go down too far. They're all illusions. They're things that make you believe that the system is there for your benefit and they're putting things in place to protect you, the investor. And that's not what goes on. Okay. So when we look at price action, we understand that if there is a absence of randomness, that means there must be a present and clear order of things. So what is that order? Well, the books will teach you, as they taught me in my beginning, that it's all about support and resistance. The problem is what support or which resistance should you use? And how do you know if a support resistance is going to hold? I get that question a lot. Before we can tackle that question, I'm going to ask you, what does the book teach you about placing support and resistance levels on your chart? Find an old high, find an old low, where it bounced, where it repelled. There's where you put your orders at, and therefore the setups are going to occur there. How many times has that worked for you? I'm sure a few of you have many examples that you could say, well, it worked here, it worked here, it worked here. But if you're honest, how many times has it failed you? A lot more, I'm sure. So the question is, if the market does in fact find support and resistance, and I don't believe there is support and resistance in the marketplace, it's again an illusion. Because what you're supposing is that specific price level in the past is going to have the exact same response going forward. And it never, rarely, ever shows that consistency. Once in a while it'll happen, enough to write books and write chapters in, enough to do seminars and webinars on. But when you start walking forward that idea, you have problems. It's like quicksand. It looks like good footing, but when you step out there, you start sinking and you start questioning what's really going on. So I had a lot of frustration in the beginning after encountering adversity in my trading. So I had to figure things out. I had to think about things from an analytical standpoint, and I will admit to you right now that I wasn't confident that I was going to figure it out, but I sure as hell tried, and I was trying every single day, more hours than a full-time job would have anyone work. 8 to 10 hours a day, sometimes 13 hours a day, and study. So I've been obsessive about this all my life. So I want you to understand that I didn't just throw this presentation together because it just fits today. I want you to go through the same mechanics and process that I'm doing here on any market whatsoever, because it's the same thing. There's always a puppeteer. There's always someone pulling the strings. It's never being left to randomness of buying and selling. Okay, so I don't believe there's support resistance in the marketplace, and I know that's probably unsettling for some of you. And I don't believe there's supply and demand either, because these are all notions that promote the idea of free trade, and there's nothing further than that when it comes to the truth of the markets. It's complete and utter control and manipulation. We are given the ideas and perspectives by industry talking heads, gurus, teachers, and such, and they could come across with the greatest intentions and well-meaning spirit, but it's flawed because it's promoting the idea that there's no one really in control of price when there absolutely is. And I've shown many times where I can predict within 1 pip or the very pip of a particular high or low of a day or a week. And to me, no one can have that level of skill or prognostication if there wasn't a method behind it that was measurable, that there was, well, data behind it to support it. Because if we understand that indicators and trend lines, you've seen all those things before. If it was beat by that, then we would all have the same settings. We would all have the same trend line anchor points. And we don't. And yet, still, the majority of people lose money doing it. So I was forced at an early age in my career to abandon those things because I want to only focus on the things that make sense. And I had to streamline my focus to things that made the clearest depiction of what price should do. And finding generic characteristics in price behavior that will repeat, not because it's a specific setting on an indicator, but because it's what price will do by its very nature. So what am I getting at? If it's not support and resistance, what's moving price? Order flow. It's all about where the money is. Now, the books will never teach you this because the folks that write these books don't understand or even know about it because they're so indoctrinated. They believe wholeheartedly that their system of indicators or their methodology is resulting in that profitable trade, when that in itself is the sheer randomness that they're talking about. It's the price action that's not random, but their reaction and result of their interpretation of indicators and their methodology, that's the randomness. The results of their system is what's random, not price action. If you look at promoters of ideas that sell systems and EAs and things of that nature, as soon as they say they have proprietary indicators, that's a red flag right there. They are not looking at what I'm going to show you today. And it's very generic. It's a very simple approach. It's about price. It's the open, the high, the low, and the close. It's a secret 4 indicator collection, and it goes by everyone. It goes right over their head every single day. So when we understand, or at least I'm asking you to suspend your belief in indicators and other methodologies, just for the sake of this video. If we can simply say that the market, and trust me on this for the presentation, the market moves where the money is. Okay, we know that they're sometimes referred to as a stop run, but the books are not always as clear to determine a methodology on how to trade with that or to avoid it. It's just written up as, well, that's why you have to have good risk management and money management, because price is random. And again, that's always been a stick in my craw. I've had a problem accepting that because people that get wealthy in the markets are not randomly getting there. They're doing things that are, again, measurable. Now, when I'm saying making a lot of money, I'm not talking about the guys that make $100,000 a year. I'm talking about the folks that make millions of dollars per month. These folks know exactly what's going on, and they do the same things over and over and over again, and they expect the same things in price action because it is absolutely controlled. So What do I mean? What do I mean by this? What do I mean by order flow? Well, when I look at price, as we're looking at this chart right now, there's many peaks and valleys in it. Now, right away, depending upon where you've come from in your discipline of technical analysis, your eye may be going to harmonic patterns, or your eye may be drawn to a supposed trend line, or some of you, classic support resistance, highs and lows, bottoms become tops and tops becomes bottoms, cliche. Whatever that is, I'm asking you to push it to side just for a couple more minutes, and I'm going to ask you, think about price. Okay, think about a price. And think about it in its 0 level. In this example here, we're looking at the euro dollar, and we have a price range of 121 down to approximately 116 or so. In that range, there are several 0 levels, or what I refer to as a big figure. And there's several 50 levels. Okay, like for instance, like 120.50 or 121.50, 119.50. Then you have the big figures, 119 even, 120 even, 121 even, 117 even, and so on. And I want you to think about how price moves above and below these 50 and 0 levels. You probably never noticed it before, but this is the beginning mechanics of understanding how price moves algorithmically. Okay, I have the 0 level, the 50 levels on the chart in red, and I've also incorporated the 20 levels and 80 levels, okay, because we're going to go over a few characteristics that are generic in price. But right away, you should be able to see that there are significant turning points at these references: 20, 80, 50, and 0 levels. Everyone out there struggles with what's the right support resistance level. And if you just simply do this to your chart, you'll have the key levels that are going to be most likely or salient to current price action at the time. Now I'm going to take that information and promote an understanding that how we can use institutional pricing like this, 50, 0 levels, 20s, and 80s, to find key turning points, okay, which will also lend well to finding setups. So right away, I want you to take a look at the reactions that take place around the 50 levels and the 0 levels. For instance, if we look at the 117 big figure down here, price was able to move down to it, but did it stop right at the level? No, it went through it just by a little bit. And then there was a reaction. Price came back down. Now, support and resistance idea, theory would say, okay, let's wait for it to get back down to that level. It didn't do it. It traded higher. And it cut through a mid figure, an 80 level, another big figure, through a 20 level, but then failed to get to a 50 level, and then fell all the way down, back down into this level. Now, right away, folks that subscribe to support and resistance, they would say, okay, well, here we are. We traded back to that level, so I can be a buyer now, and I'll put a stop loss rate below my low. And they get rewarded for a little while, and then price comes back down and drives through. Why is it doing that? Why is it doing it again here? Because these double bottoms are designed to lure your eye to it and feel that it's safe to put your stop loss below it for a long position. Whenever we see price points in charts that have equal levels, that's an opportunity for a raid. Price should go down there, probe that area, and then anticipate a rejection and go the other way. Another example is here. Double tops. Price runs through it. Now, this time it runs through it and doesn't reject. The reason why is because we've had a market structure shift inside this area right here. After trying several times to get below 117 big figure, the algorithm was not allowing price to go below. It wasn't the fact that there was no sellers, and it wasn't an imbalance of more buyers than sellers. The algo was working this level, 117. How do you know it's working it? What does that mean? It's going down to it a lot and sweeping through it. That means they're accumulating long positions down here. Every time it makes a lower low, everyone else's system will say that's weak. It's making lower lows. No, it's accumulating buy orders with the existing sell orders that are in place below these lows. Now, I want you to think about how when price reaches up to a 0 level or a 50 level, it's significant. Okay, they're kind of like mile markers. So if we can trade through a 50 level or a full figure handle, okay, 0 level or 50, that to me, if we understand the daily bias as well, if you think about what I taught in the high probability scalping series of 3 videos, the concept of determining what the daily bias is in that series is really simple. And you stick with that daily bias until we get to a potential turning point. And that's going to be on the hourly chart, which is what I'm showing you here. Everything I'm showing you with a purpose in mind should help to remove the anxiety about what support resistance levels you should be looking at, and by the time I conclude this video, where you can put your fibs, okay, and remove all that ambiguity. So we're going to assume that we've arrived at a bullish idea that the euro dollar is going to go up from here. It doesn't matter that you missed the buying low point down here. It's not important. Okay, that's not the important part at all. What I want to show you is there are folks that will argue, okay, and suggest that a lot of the things that I teach or show, it's been cherry picked for the purpose of looking good. And I'm going to show you how that's not true at all. Okay, and you can find the same types of setups, and you'll see that they are cookie cutter. They're the same type of thing all the time. And it looks like, to the uninitiated, like perfect hindsight cherry picking, but it's not. I'll give you an example. All right, so we had all the sell stops ran out on this big figure at 117, okay? And then price rallies, and it takes out a key swing high. Now, why is this a key swing high? Because it's come all the way back down, taking out lows. So if it breaks this high, that will be a significant event in price action, at least for the euro dollar on an hourly chart it is. Price then, after making a higher high than this swing high here, it starts to retrace and comes back down. And it finds a reaction right here and bounces up again. Creates an equal high, starts to come back down. Folks in the retail world will see this as resistance, not you. There has been a shift in the market structure, rallies. Now, what I want you to do is, I want you to think about, and I'm going to zoom in here, swing high that broke this swing high. Now we have a bullish market structure. There will be folks out there that will say, hey, these educators, they put their fibs in after the fact, so that way it looks good. And they'll do something like this. Oh, and that's great. Okay, that would have worked because the stop would have never been hit. Okay, but you're looking at a swing low. You're looking at the actual price points. Okay, and the reason why I teach folks to focus on the bodies of the candle is because your broker has the wonderful flexibility that you both agreed to them having about delivering the price to your platform. And it will always be slightly different than what is actually on the interbank level. Now, I'll say that again in layman's terms. Everyone's broker's price is going to be slightly different because it benefits them in-house on their own books. Their own customer base will be cannibalized when it's convenient for the broker. Okay, so I want you to remove the idea that you have to know what's swing low and what's swing high to put your fib on. Okay, forget that, because that's what the books teach. In 1994, I was looking at the Japanese yen of all currencies I know. The Japanese yen, I was trying to figure out what I wanted to do with that currency. And now, it was before I was trading Forex, because Forex wasn't permitted to be traded prior to 1995 unless you were a bank. But in 94, I was looking at the Japanese yen, and something struck me as just a point of study. I needed to get into the marketplace and find, what could be seen in price that repeats itself over and over. I was struggling to figure it out, because I knew that I could come up with a way, and at the time I was going to write a computer program that would make my trading automated. That was my intent. But because I had to understand how it could reference certain price points to basically build a condition for bullish or bearishness, I didn't want to use moving averages because I didn't believe in them, because eventually the moving average, at the highs will have you buying and it's over, it's done. So there had to be something for me to use as a criteria to determine where value is, where overbought is, where it's cheap, in other words, oversold, overbought, and where it's a good price to buy or where it's a good price to sell. And I wanted to make it as generic as possible so that way my program could reference these price points from a very generic standpoint. By that choice or pursuit that particular day, it was July 10th, 1994. I remember writing it in my log, in my journal. I said, I want to incorporate this specific thing in price action. Now, I did not know the ramifications of this observation in price, and this is only by me studying price action alone and disregarding my indicators, because I had a lot of indicators at the time on my charts, but I stripped it down and I said, okay, I need to know what price is going to do that can be seen and measured over long periods of time, not just perfect examples in hindsight. I need to be able to see this stuff going forward. So once I adopted what I'm going to show you here, it made perfect sense. So that's the reason why I could do, and I actually contemplated doing this for about a week. I was going to plot my fibs as I'm going to teach you here, and it would have drove Twitter crazy. Oh, he's putting it where it makes sense for him, and you would have never seen this. And I'm telling you this, and I'm challenging you. You find this in any book or educator, and it's got to be printed or in video where you can see it before the fact. Okay, like I know it doesn't exist because I buy everything, but this was never taught to me in any of the things I've ever seen. No one else teaches it, and again, it's just one of those things that you get, or at least I received it, by just being insanely focused. And from a standpoint as a computer programmer, I needed to be able to reference a specific price point. Now, I'm going to say this, and I want you to really pay attention, because if I've lost you by now, okay, this is going to hopefully get you excited. Your broker's high and my broker's high are not going to agree. Our lows are not going to agree either. There's always going to be some slight variance. Why is that? Because it's economical for them as the broker to manipulate price, to shorten the spread, to widen the spread when it's convenient for them. That's the reason why I teach to use the body of the candle, because that's the bulk of the volume. Now, it still is not going to be lockstep for step the same thing you would see on the interbank level. That price is not going to be delivered to your demo account. It's not going to be delivered to your live account, and I don't care what broker there is. This is the reason why I avoid the broker discussion, which is the good broker. It's up to you to decide that. I don't ever want to promote the idea of one broker being the safest one or the best one, because there isn't anyone like that. They all have a vested interest in making money off of you. So if you lose money, I don't want you saying that I caused you to lose money with that broker because you made the decision on your own. Okay. I will say this: if you go through and do a reasonable research on the internet and talk to people that are actually using them, that's the best feedback and selection process there is. Okay. Because the ones that are big name and doing very well, they didn't get there, overnight. They've been able to hold a good customer base and retention. And there's not been enough horror stories to put people on the sidelines about putting money with them. Okay, so I'll just say that for completeness sake. But there are folks that will teach that the Fibonacci needs to be placed on the very, very low up to the very, very high. And sometimes that works, and sometimes it doesn't. And I teach that you should put the fib on the bodies, lowest open or close at a swing low, up to the highest open or close in a swing high. And sometimes it doesn't work. What is really going on is price is gravitating to these four levels. Now think, I gave you a science to finding support and resistance just now, and you don't even realize it yet. I've also gave you the science behind why my fib works when it works, and why I only look at specific swing highs and swing lows. Look closely. Price breaks this swing high, comes back, cycles back down into the mid figure. Okay? I want you to think about where price originated from. It started sweeping the 17 big figure, right? And price traded all the way up and traded into the 1820 institutional price level. Now, it went a little bit above it, but I don't want you focusing there. It worked off of 17 big figure up to the 1820 level. That's where you anchor your fib. If you put your Fibonacci on the 117 big figure, notice I'm doing it away from any swing lows, any highs, any lows. Forget that. That's retail thinking. You got to think with an institutional mindset, because this is how the algorithm delivers price. It comes exactly down to the 62% retracement level, then we get a pop. Comes right back to this same price level. See where it's stopping? It's not stopping at the high, it's stopping at the 20 level. Okay, now same premise in mind. Okay, watch what happens. I'm going to take this fib off, and I want you to think about this area right in here. Now, there will be folks that say you need to put your fib on this low up to the highest high, and let's do that. On the lowest low, on the highest high. Yes, we get it hit right here on 62% retracement level. Beautiful. Nothing wrong with that. But I want you to think a little bit differently. Watch what happens. I put my 20 level back on because I took it off. And I'll take this off again. And I'm going to calibrate my fib to the actual 50 level, not looking at the actual swing highs and swing lows. I'm putting it right on the price level itself that price is working, the 20 level, off of the 1750. So in other words, look at price hitting 1750, then reaction happens there. Who cares about the actual low? Because your low is not going to agree with mine, and it's not going to agree with the 50 other people either. Only the same people in that same respective liquidity pool or broker is going to have the same agreement. So, and even if you do that, if you look at like FXCM, they had many ways of looking at price action. I had people that were trading live in FXCM, and I had a live account with FXCM at one time, and we still didn't even agree on our highs and lows. So this is the reason why I'm telling you, forget the folks that tell you this is the proper way of putting your fib on the low and the high. Forget that, because that's not what's going on. Okay, price is moving to these 4 price levels, and they're reacting off of that. Now, when we know this, we can see the anchor point is the price level, not the very high or the low, not the bodies of the candles either. The bodies of the candles will get you the closest thing to it without me teaching you this. But I wanted to answer this response because I got a couple emails from folks that really support Tom Dante. And again, this is not like a pissing match, okay? I'm not trying to do that to be disrespectful or anything, but I got to call a correction when it's necessary. And this is what really should be done with a fib. Looking at the reference points. Whenever you think you're going to put your Fibonacci on a swing low, find out what level it is. If it's a 50 level, an 80 level, a 00 level, then that's what you put it on. That's it. Forget all this other stuff, because that's always going to be erroneous price action. Not in the sense that it wasn't necessary, or that they weren't doing something to reach for stops or something like that, or defending a level, not going down to it as many times as they would be reasonably expected to see it. It just means that you have to think about how, if price was controlled by a computer program, there's no way on earth that it could ever see all of our orders. It can't. But when it goes to these levels and sweeps through it a little bit, that's all that's necessary, because the common thesis is stop losses are just below an old low or at the old low. So they go to that specific price level and they whip through it just by a little bit. They don't know where your orders are specifically. They just know where they're likely to be at. Think about that. Now, right away, if I have my anchor points on the price levels as indicated here, I got a deeper retracement that goes just a little bit below 62, but nonetheless, it's still there. Price rallies again and takes off. Now watch what happens here. If we see this buy point right in here, well, how's that a buy point? Is it going to be a Fibonacci retracement? Well, let's take a look at that. We're going to use the standard technical analysis way of doing it. We're going to put it on the low up to the high right there. Well, we didn't get down to 62, we didn't get to 70.5, and we sure didn't get down to 79% retracement. Didn't do it. So we can't look at this as an optimal trade entry because it didn't retrace deep enough. So therefore, Fibonacci traders and those that use the methodology as taught by the books and everyone else uses online, they miss out on this buy. But now, do what I taught you. We're going to calibrate it to the level. We're going to start with the 80 level, and we'll drop it down into the 50 level. Okay, so right away we have a shortened range in here. We have a shortened range. Price has blown through what key price level? What did it just shoot? What did it just shoot through? Right here, off of this run, it went through the big figure 119. So if it's going through with energy to get through 119, shouldn't it be reasonably expected for it to maybe retest 119 or try to stay above 119? That's what the algorithm does. It determines these mile markers in price, and once it overtakes a key big figure or a mid figure, it will either come back down to it, or it won't come back down to it, or it'll come back down through it in reverse. There's three conditions you have to have. Now again, the folks that understand computer programming understand exactly what I'm referring to as if-then syntax. It's logic behind the decision making that controls what the outcome is going to be. Here, I want you to think about the idea of how much energy it took to get away from 118 to get up to 118.80. Then it paused, then it ran aggressively again through 119 big figure up to 119.50. Then it starts to retrace. Well, we've cleared a big figure. My mind right away thinks we probably will come back down to 119 to retest it, but in the event that it doesn't, what setups could be manifesting there? Watch. Put the fib on the 119 big figure and on 119.50. I'm going to zoom in so you can see it. Boom. 62% retracement level. There's your optimal trade entry. Now, I'm going to be honest with you. If I would have put this on a chart, okay, and anchored the fib right here and up to here, everybody would have been screaming, "What in the world? This is cherry picking. He doesn't know how to use a Fibonacci." Really? Because I've been doing this for a long, long time, and it's not just these examples that it works on. I'm telling you to go through your charts and you'll see it. When price is bullish, as Eurodollar was, it's going to be reaching for levels. Okay? Why do I want to exit early? Like, I think that price may go up to a specific price level. Maybe ADR is suggesting things. Maybe I've done some Fibonacci extensions or whatever. But I want to get out at the most logical price points. And they're going to be as close as I can to these four price levels. Look at the delivery of price here. It went right to 120.50. Yes, it went through it a little bit. I am never concerned about that. I don't care about that. Okay, what structures my trade is? Do I have the ability to get to these levels? Look how nice and easily got to this 120 big figure. It's easy to understand the mechanics when you think about price like this. Remove the notion of you have to have the right swing high and the right swing low. No, you don't. You don't need that. You need to know where you are in terms of valuation. What's the price at? Think about this over here. This axis on your chart is the most important thing. Then this one down here, it's time. When those two agree and a bias is in play, in other words, are you bullish or bearish? There has to be a stage, okay? What makes the setup or condition bullish or bearish? That's where the hardest work for you is, because the entry patterns are they're the easiest. They're the easiest. The hardest thing is for you to determine should you be a buyer or should you be a seller, and stay in that camp until your setup comes. Period. Simple as that. Now, we're going to take this idea and we're going to switch it to when things are bearish. And I'm going to look at this little point right here. Now, if we were looking at classic Fibonacci application, here's a swing high, and we'll put it on the high here, down to the low. Didn't even get back to the 50 level, or equilibrium would be. 62 is up here. So how can you get a sell signal here? Think about price from an algorithmic standpoint. What price did it just leave? With energy, it left the 120 big figure. So it left the 120 big figure, traded down to 119.50. Where should your fib be placed? On 120. So you have 1950, 120, boom, 70.5 level. There's your optimal trade entry. I know, right? Folks, it's not about picking the right swing high and the right swing low. It's about understanding what price is doing. It's all in open, high, low, and close. What is the price it's working off of right now? I gave you 4 price points. 0 levels, 50 levels, 20s, and 80s. It's as simple as that. There's your support and resistance. The thing you have to know is, where is the bias? Is it bullish or is it bearish? When you know these things and you apply it, you will see things that no one else sees. And no one in the teaching circuits teaches this. It's mine. This is the byproduct of having an insane interest in knowing what price is going to do, and having a degree in something that it couldn't make money with. I went to school to learn to be a computer programmer. I've never received a paycheck one time doing that, but I've received huge paychecks by way of using this information and thinking about things from an analytical standpoint and trying to formulate analytical and algorithmic approaches to deciphering price action. Let's show some more examples here. If you look at how price is moving, okay, we left the 120, went down to 1950, down to 19 big figure, swept through 1850, fell short of 1820. Okay, so we fell short of 1820. So are they supporting that price level? Well, they showed a willingness to go through a short-term high here. So even though it never touched that level and showed a strong reaction, your broker may not have that low touching this institutional level at 20. I still would use that. I would use that reference point. So let's take a look at applying the fib on here, 1820. And this is the part that's going to seem like form fitting, okay? But the question is going to be this. When you're looking at these levels, the questions I ask myself is the level being worked up and down around it? And did it leave it? Did price get away from it energetically? Above it, like moving bullishly away from it, or bearishly moving away from it? Because it's going to give you a tip as to what the algorithm is trying to do. Reprice higher or reprice lower. Now, also, I'm also determining whether there's a willingness to get down to that level. And if it fails to get to a level, going up to it or going down to it, I will still use that level because it's being defended. The algorithm is trying not to go beyond that price point. The reason why you're going to struggle with this is because you have to submit to the idea that your retail account may not show the price level itself. But when you put these levels on your chart, it will help you decipher what price is in fact probably doing. Now, you may have expected price to hit that level, okay? And admittedly, I probably would have been expecting that same thing to occur here. But when price reverses and trades through the short-term swing high here, when I see that, I know that they defended the 1820 level. And nothing's changed. It's the same thing as if you were looking for the setup to occur like after the fact here. It went above it. Okay, great. I'm going to look for a buy signal on the same context that I just framed the earlier buy for this. So we're going to anchor our fib right on the 20 level, draw it up to this 1980 level because price did hit it and had a reaction off of it. Now watch closely. I'm looking at the price level. It jumped on my platform to that low. I got to make sure it doesn't touch that. Okay. So we're on the 1820 level up to the 1880 level because it traded to it and reacted. So, and price comes back down here, this is a buying opportunity right there. And then we can start looking for these targets here. Okay. Run for this old high. Let's just watch and see what happens in price. Using institutional price levels, not swing highs and swing lows on price, not stressing about, well, you know, there's certain educators out there that cherry pick and they put this stuff in. Tom, I'm going to put that at rest with me because it doesn't work with me. That does not apply to me. I'm not saying you did associate that with me. I'm saying just in case you did, okay, I want you to know that there's absolute science behind where I put a fib at. Price meanders, goes forward, and look at the reaction right there. Beautiful. That's a buying opportunity as well. And what's resting right here? Equal highs. Price should react to go where? Boom, clear that out. Underlying premise behind the market price is it's bullish still. Boom. Boom. Hits it. It's over. This is what I'm talking about when you have to look at order flow. I'm not using these gimmicky things that they're in fashion right now. You know, just like supply and demand was in fashion about 5-6 years ago, and you know people still have a faith in that. But I slice and dice that theory too because they have limitations on it that don't make sense. Don't cut through candles. You have to cut through candles to get context in the market. You have to know certain things. And if you start putting parameters on that says you can only look back to this price point here and never cut through a candle, that doesn't make any sense because you'll never understand a real stop rate, okay, or a run on a key level if you don't cut through candles. And supply and demand teaches that you can't do that. So let me take that off. We're going to take another couple more examples here, and I'll end this video because it's getting really long-winded. But the idea is just to stimulate your thought processes behind it. It's not an absolute science for you as it is for my mentorship. Okay, I'm just giving you examples of how it is unchallenged. It cannot be rivaled by any other retail approach. If you want to put a Fibonacci on your chart, do it with this in mind. And I'm telling you, you will start looking like a wizard. You'll see things that no one else is talking about, and you'll be pulling trades out of the marketplace that no one else would be doing either. Price keys off of the 1850 level again. I'm not going to the swing low. I'm going right off the level itself. Okay. And we're going to go right up to the 1920 level. Boom. Optimal trade entry. So forget all this. Say you didn't even see this, didn't even worry with it. You want to be a buyer? No problem. We can capture the buy here. Okay. Same thing. We want to look for projections on price once it starts to move out. If we take out this swing high, which is the old one, how far can it go up to? Here's a 200 extension. Boom. Beautiful. Undone. Completely decimated the euro dollar with that. Now, did I give you something retail here? Is there any trend lines on it? Any moving averages? Any stochastics? No. I used the Fibonacci, but I used it in a way that we can grade institutional price swings. The markets move from an algorithmic standpoint. They're predictable. You can make a science out of why it should go where it should go. and where you should get in at. Getting in is the least important. You have to understand what side of the marketplace it's going to go for, the up or the down, the bullish or the bearish. Okay, so that means you need to know what the draw is on price. Well, at this point here, buying here, the draw is above this old high. That's where their buy stops are going to be. So even though this is suggesting that this is a good level to take profit at, and it's a real nice reaction there and trades back down, watch what happens again in this little muddy price action in here. You probably know where I'm going with it. This will be the last example for this presentation. We have price reacting and sweeping through the 1950 level and then rallying up, then coming back to a shallow retracement and falling short of getting to the 1980 level. Forget all that. Where's the price points? 1950, 2050. So we have a 100 pip range. Put it right on the price levels themselves, right there. Okay. So we're anchoring off this level, not the swing low, not the wick. If I would have put this on here, why the hell did you do that, ICT? You would have been thinking, oh, he put it back here because this is that level here. No, you would have never figured this out. You never would have figured this out. Okay. Looking at price, reacting at 1950, that's the level it was working. The algorithm went to that level, but swept it. So the real key work is 19 mid figure. Okay, so 1950, it rallies, goes up to 2050 or 20 mid figure, then retraces back down. What's it hitting right here? 62% retracement level. Boom. What also is it happening? Order block. So now you got two things going for you. Institutional order flow, bullish order block, optimal trade entry, buy it. It's going to go above this high for the stops. Here's your fib target, and look at the bodies of the candles. Very close to what would be acceptable as a target. And yes, it wicks through it a couple times, but that does not concern me. Okay, I want to know these levels here. Okay, and this is a buying opportunity that no one would look at this and say that's an optimal trade entry because they look at just my tutorials. They don't have this insight, but now you have it. Okay, if you want to learn things like this, and you want to apply certain higher level theories that I don't make or will ever make them public beyond what I've done here, the mentorship is for you. If you're not wanting to get to this level of insanity in terms of understanding what price is going to do, then you just stick to the free tutorials and that'll be fine. But I just wanted to kind of like answer a response I got. Well, I didn't really get it, but I heard it in a video by another educator, and I just wanted to put my 2 cents in because I get a lot of opinions expressed about me and about my methodology, and many times it's done by way of ignorance. They don't really know what they're talking about, and they're grading me or suggesting that I'm doing certain things when they have clearly no idea what I'm doing. And I'm going to leave it at that, okay? But there's so many examples in here, okay, that it's crazy. Like I'll give you one more because I just want to do it. We have a swing high here, okay, and we have a swing low here. Really nice sell-off here. So what was the catalyst behind it? Well, if we put our fib, obviously the market has shown a willingness to break down up here, and I go through tutorials showing you that. Now the swing high, the swing low camp will do this, okay? Great, it gives you 62% chase. Great, nothing wrong with that, okay? But in my mind, what I'm doing is I'm doing my fib at the level itself at 20, 1920. I'm dragging it down to 1920. So 2020 to 1920. Why am I putting it down here? There's no reference to this swing low, Michael. That doesn't make any sense. This is stupid. You don't know what you're doing. Sure I do. Price done what? It reacted by going higher and failing to get to 1920. So what's the algorithm doing? It's defending 1920. Well, how do I know that? Because it took out a swing high. Uh-oh. Well, wait a minute, Michael. Isn't this one of those breaks the swing high, comes back down, optimal trade entry buy? No, because the context is the market's broken down back here. That's why some of you look for optimal trade entry longs and you don't get them. You get these smashed through and, oh no, how do I know? You have to know what the market's showing you by context. Context is, what's the storyline behind price? Is it bullish or is it bearish? And has it reversed? Because if it has reversed, well, what's the reversal here? Price went above an old high, failed to go higher, and came back down. Find the reaction low in between. If it breaks that, it's bearish until it resumes going higher again. So this whole model here is bearish. So my optimal trade entry would be framed on something like this. And it takes me deeper. So I'd get a slightly higher entry price than if we were to use this high to this low. And look at the consolidation of price action. See the bulk of the volume in there? You're not seeing that. Okay, in other words, look how much time the institutions were given the opportunity to get short in here before the big move drop versus something like this. If you just do this, retail, okay, gets 1, 2, 3 chances. Maybe if you want to count this here, how many times are you really going to hit that at 62? No, you're probably not going to do it. You're going to want to get up here and deeper and get some kind of a better fill. That's not what I'm doing. I'm looking for reasons to justify this openly and outwardly to the public, but many times my personal trades are framed with what would otherwise be seen as no basis whatsoever, but there is a rhyme and reason behind it all. Look how much time price spends in that 62 to 70.5 level right in here. Lots of opportunity to get short there, and then finally, boom, the big cave in, and you have your targets. Boom, the target 2 hits it, but also reaches more specifically for the 1850. Price wants to go to these levels, folks. It's not random. Now, obviously, I did not give you do this every single time. I've given you an idea because that's what started back in July 10th of 1994. This is what I wanted to start looking for evidences of. And it just so happened that it provides a wonderful opportunity to also segue into answering, in addition, with greater detail, why Fibonacci shouldn't be so forced on swing highs and swing lows, because that's not the magic behind it. Okay, and the reason why the Fibonacci is even showing a willingness to have a profitable signal, if you want to call it that, it's just using a reference point of overbought and oversold. That's all I use the Fibonacci for. I don't need it for anything other than that. So I go into great detail about that in the mentorship, but if you want to trust the fact that the Fibonacci does all the work, but you want to use it like this and have the daily bias understood, then that's fine. You could be a subscriber in that view, and it won't hurt anything. It'll still give you the same result. But I know some of you are just really, really keyed up about wanting to know everything there is that I know, and these types of concepts and things, they get taught only in the mentorship. So, and you will be able to see a lot of opportunities that would otherwise evade you. And until next time, I wish you good luck and good trading.